In this month's layoffs at Credit Suisse's New York office and Hong Kong office. UBS Group is planning to cut more than half of Credit Suisse's workforce. Most activities in Credit Suisse's investment bank in London, New York, and some parts of Asia are at risk from the cuts, according to people familiar with the matter. Ultimately, UBS plans to reduce its headcount by around 30%, or 35,000 people. According to two people familiar with the matter. Redburn analysts estimated a reduction of around 30,000 in their report on UBS this month. Due to the bank's merger with UBS Group, Credit Suisse plans to lay off about 80% of its investment banking staff in Hong Kong. James Jim Rickards is a renowned author, lawyer, economist, and finance expert who predicts the US dollar will falter in the wake of a new financial crisis. According to the expert, central banks have still not recovered from the previous crisis, while Russia and China have been buying gold at unprecedented levels. Silvergate Bank, Silicon Valley Bank, Signature Bank, Credit Suisse, and the potential failure of First Republic Bank are examples of the new global financial crisis. In spite of the UBS Credit Suisse shotgun wedding on March 19, the crisis may not be over. In the coming months, there is a good chance that there will be more big bank failures and continued stress on the system. The financial crisis comes on top of an emerging recession, as evidenced by shrinking global trade, declining manufacturing output, tightening monetary policy, continued inflation, and falling housing prices.
Jim, where do we start? I mean, the last 3 weeks in the banking sector has been hard to fathom. You and I spent decades in the banking sector. I was talking to our good friend Robert Kiyosaki last week, and he said, Brian, they're centralizing banking. What is your read on Silicon Valley Bank, Credit Suisse, Republic Bank, Deutsche Bank, everything we've seen over the last 3 or 4 weeks?
Well, first of all, it's a good capsule summary, Brian. But of course, the Silicon Valley Bank was taken over by the regulators on March 10th. But you can see it coming. It was in distress. There was $40 billion pulled out of that bank in one day on Thursday, March 9th, the day before it was taken over. $40 billion just hit the road, just left. It was a complete collapse. And I was having a discussion with my editor, my managing editor of one of our publications, Strategic Intelligence. And we had, you work a little bit in advance, and I planned to write something for our April issue on climate change. It's a big subject, and I had outlined it. And he said, Jim, we got to do this banking crisis. I said, of course, let's put climate change down the road. We'll work on the banking crisis. So I started researching, writing on Silicon Valley Bank. And then I'll get into more detail, but 2 days later, they took over Signature Bank. So, well, we got two banks now. We got to, zero in on this. There was a crypto connection and Signature. We'll talk more about that. And then the next day, First Republic hanging by a thread. It's still hanging by a thread, by the way. Again, we'll go over all this in more detail. And so I couldn't write fast enough because as I'm writing, the story is unfolding. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's, it's a free country. You can do that if you like, but she wasn't running the bank and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse. And then here comes Credit Suisse, right? The one thing I know, maybe a little before your time, Brian, but there was a very, very popular rock celebrity writer in the 1960s named Marianne Faithfull. She had a great career, lots of hits, Mick Jagger's girlfriend, etc. But her summary of the 60s, she said, if I wasn't there, it didn't happen. And I thought that was a very, very good way to put it. In her case, that was true. But I started to feel that way about financial crises. If I wasn't there, it didn't happen. I go back to the Herstatt Bank collapse in 1974, which was a shock. That was back before that was a foreign exchange crisis, but it highlighted the fact that when European banks closed and the U.S. banks were just opening, if you had a failure here, it never settled over here. It wasn't real-time settlement, so there was just all these open positions of a bank that had just failed. The S&O crisis in the 1980s, the Latin American debt crisis, the early to mid 1980s. The flash crash in 1987, the Mexican tequila crisis, 1994, long-term capital, Russia, 1998. Of course, I negotiated that bailout dot-com crash, 2007 mortgages, 2008, everything falls apart, 2020, COVID, and now today. So I don't know if I'm a magnet for trouble, but I've seen my share of financial crises. And as an analyst, they have certain things in common. The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of the hat, played all their cards? And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves.
You mentioned the velocity of this happening, and I want to just quickly talk about that, Jim, because you just said $40 billion being removed from a bank in 24 hours. Like, I didn't even think that was possible. And put that on top of, or maybe that's because of, the rumors spread so fast. And again, you've lived through this at Long-Term Capital Management in '98, and you've seen, like you said, a litany of bank failures. Tell me about this one and how it's different now, and I guess forevermore, with the fact that we've got Twitter, we've got social media, and we've got electronic banking. I actually still am flabbergasted that people like Peter Thiel could take out billions kind of online. I remember famously, Jim, when the mortgage crisis happened here, I wanted to get my money out of NatWest. And funny enough, when I called them, they wouldn't let me do it on the phone. They said, you have to come into a branch. And I said, oh, I see what you're doing. You're trying to stop a bank run. I'm like, I'm sure that's not legal, but I get it. They were putting frictions in place. I had to go and line up with 100 people. And then by then it was either going to be over, or I couldn't do it, or it would slow it down. But speak on maybe how fast the rumors spread, and then how fast people could get the money out, how that's different than the previous ones you've seen.
Well, you make a very good point, Brian. So let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy, no reason to mention names, but runs one of the largest endowments in the world, and he said, Jim, we were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you have to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We did end up moving the money. But there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo. And it worked out. One of the big crypto promoters, they forget the name, well, the particular name of the bank, but they backed one of the stable coins, actually it's USDC, had $3 billion in Silicon Valley Bank. And they talked about, all these small entrepreneurs and startups, they got 100 employees and 5 million in working capital, and that money's gone and they're all going to fail. There was something to that. But the fact is you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured, no worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years. And they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people, almost nobody knew at the time, except the management, although they seem to be asleep at the switch. Everyone's like, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies, who are extremely powerful. So so that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. And then the week after that was something else. But they always announce the collapse on Friday, and they announce the relief on Sunday. So they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. But so on 6 o'clock on Sunday, March 12th, 48 hours after the FDIC announcement, the government said, just kidding, the deposits are fine. They did a complete 180 under pressure from the Fed, the White House, et cetera. Even though FDIC did the right thing, legally, they said all the deposits are good, all of them, including my friend's $8 billion and somebody else's $3 billion, et cetera. And then they went further, and this is what I meant, Brian, by the biggest bailout in history. Jay Powell said to every member bank, not Silicon Valley, but every member of the Federal Reserve System, if you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down, rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a one-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but, let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple trillions of dollars of bonds that fit that description I just gave you. Now, the banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a one-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they were taking the money out. But better yet, I don't have to record the loss. See, because I could sell the bonds in the market and get cash and pay my depositors. But the minute I do that, I've got to mark down my entire portfolio. And by the way, those unrealized losses, estimate probably $800 billion in the banking system as a whole. So you've got $800 billion of buried losses. And here's the Fed saying, we'll give you, 100 cents on the dollar, even though your bonds are worth 80. And you don't have to take the loss because it's structured as a loan, not a sale. So this is a multi-trillion-dollar bailout. It's legal in the barest sense, but it's an accounting game. It's a bailout game of unprecedented magnitude. And by the way, we'll get, a year from now, March 2024, they'll extend the loan. I mean, right. It's only 1 year. Yeah, exactly. Right. You're not going to be able to repay this. Who says interest rates are coming down? We'll see, but they're not going to, they're just extended. So, but this goes back to my earlier point. What else you got in your bag of tricks? I mean, you just guaranteed every deposit in the system de facto. You just guaranteed par value for, trillions of dollars of government securities that are underwater. You just told everybody they don't have to record any losses. You've just given them all the cash that your printer can print with no consequences. But then they go, what else have you got? There's nothing else they can do. And one more twist on this. Remember what the Fed's been doing for the past 14 months. They've been raising interest rates. Yeah, we know that. But they've also been reducing their balance sheet. I run into people all the time. They bang the table. Hey, the Fed's got to stop printing money. They're printing too much money. They've been burning money. They've been reducing the base money supply for over a year, about a year and a half. Well, now, okay, so the base money supply is coming down. Rates are coming up. But what does it mean if $1 trillion worth of bonds show up and the people, the banks delivering the bonds say, give us the cash. Where does the cash come from? The Fed prints it. So now you're going to expand base money by perhaps $1 trillion or more at a time when you've been pretending to reduce base money. So this completely blows up their monetary tightening. Okay, they're not cutting interest rates. That we'll see what happens there, but they are increasing the money supply by, again, estimate upwards of $1 trillion. So what happened to your inflation fighting? What happened to your monetary tightening? And they just want to pretend. I mean, you do have to, you do have to be expert to understand all these mechanics, but they're not that hard to explain. I mean, you can just say it in plain English, which is what we're doing. But from a policy point of view, it completely blows up their monetary tightening.
It is similar to the global financial crisis of 2008, when a financial crisis and a recession combined. Investors are rightly concerned about this combination crisis, but there's another threat that may be more dangerous than a recession or panic that could make 2023 a trifecta for the ages. The threat is the possibility of the U.S. Treasury going broke and defaulting on government securities and other obligations. Congress has failed to raise the debt ceiling, posing this threat. The debt ceiling is a statutory limit on the total amount of debt the U.S. Treasury can issue. The Treasury issues more debt every few years to finance ongoing budget deficits. The total U.S. debt today is about $31 trillion. That's the amount of debt in the form of U.S. Treasury notes, bonds, and bills. There are tens of trillions of dollars in contingent liabilities from Social Security benefits, Medicare benefits, student loans, and mortgage guarantees. For now, let's focus on the $31 trillion of bonded debt. According to him, the world was completely unprepared for the next crisis, which will be much worse than the previous two. Rickards argues that the 1997 to 1998 Asian financial crisis could have brought the world to its knees if Wall Street banks hadn't stepped in to save U.S. hedge fund long-term capital. In October 1997, the Dow Jones Industrial Average recorded its biggest point drop in history due to the global economic crisis, resulting in a trading suspension. A $3.75 billion bailout saved long-term capital from disaster. A cascade of secondary bank bankruptcies would have occurred if it hadn't been bailed out, with Deutsche Bank, UBS, and HSBC reporting they contributed to the bailout or wrote off hundreds of millions of losses. In 2007 to 2008, the global financial crisis was triggered by the subprime mortgage market in the U.S. and excessive risk-taking by banks. As a result of the crisis, Lehman Brothers went bankrupt, causing the Dow Jones to fall to its lowest level in 7 years. The U.S. Federal Reserve increased its balance sheet from $800 billion to over $4.2 trillion as part of this bailout. Fannie Mae and Freddie Mac were taken over by the U.S. government, while Merrill Lynch, Wells Fargo, and Bank of America received hundreds of billions in bailouts from the U.S. government. Gold will become the primary valuable commodity as the crisis unfolds, rendering the U.S. dollar worthless. Nevertheless, Mr. Rickards said he preferred to own mostly physical gold over gold futures, options, unallocated gold contracts, and ETFs. According to him, there is not enough gold in warehouses to meet these paper claims. It was slightly different owning shares in gold mining stocks. The gold belongs to the miner, not to you. Mr. Rickards said the management team is just as important as the geology, location, costs, grade, and processing methods. When investing in gold mining companies and explorers, there are some gold companies with great management. They have a track record of controlling costs, etc. Some of the gold companies are frauds. Others may not be frauds, but have poor management. Obviously, you don't want to be involved in them. According to Rickards, he does not foresee a dystopian future or an end-of-the-world scenario. The crisis, he said, will begin with enormous social unrest.